10-year Treasury hits a 52-week high, and we are near the highest rates of the year. But are we going to get over the hump next week and clearly see the highest rates in 2026? And let's just refresh what happened this week, because there was a lot of things that have affected today's rates. The big one is we had the Fed meeting on Wednesday. As we know, everyone was hawkish. We had 3 members vote for a rate increase. Fed Chairman Warsh was hawkish, stating that the Fed is determined to get inflation back down near its 2% target and will not vary from that stance. Now, we did get a good PCE report, once again showing inflation is pulling back a little bit, but not enough to influence the Fed. So therefore, that hawkish stance is going to be something that we're going to have for quite some time. It'll keep interest rates elevated. We're going to need consecutive months of inflation pulling back. Now, the other thing is geopolitical tensions. They seem to be once again on the rise, and it's just tremendous uncertainty. It's weighing on the markets, and everyone, I think, is over it. So who am I with this great knowledge? Before I get to my third thing, my name is Kevin Weedmark, aka the Mortgage Mouth. Each and every day I come to you with what happened in the marketplace, how it affected interest rates, what do we got coming out into the future, and should we float or lock? And the last thing we had today is month end. So you had a lot of bond traders just repositioning themselves. And the other one that repositioned itself today was our own federal government. They did a lot of bond selling today as well. And that is what I think is temporary. So as we head into next week, I think we'll see that correction. I think 4.7% on that 10-year Treasury is kind of the high end. So the fact that we're slightly above it, I think we should be sitting below it with where everything sits today. Next week, we're back to the labor market. If we get numbers that blow away the labor market expectation, then you're going to see interest rates go up a little bit. Obviously, the Fed has 2 mandates, the labor market and inflation. They're clearly focused on inflation, but if you're getting a labor market that's just blowing up, obviously I think that's going to push interest rates higher, because the Fed will have absolutely zero reason to possibly reel the Fed funds rate in. And lastly, should we float or lock? I'm floating into this weekend. If you're looking at the highest rates potentially of 2026, I'd float it out. I'd cross my fingers that we get some resolution to this conflict. We get oil back down below $80. We saw better interest rates. We saw the 10-year Treasury below 4.6% at that point. And lastly, if you do need to lock, always utilize yield spread premium or seller concessions to offset those closing costs, creating more affordability and thousands in your pocket. Have a great weekend. You want a topic covered, you got a comment, please bring it. And as always, remember to subscribe so you never miss a beat. See you next week. Cheers.